Hello and welcome to our channel at Insurance World TV. In our previous video, where we discussed the insurance industry outlook for 2026, we briefly touched on IFRS 17, the International Accounting Standard for Insurance Contracts. We've since realized that this topic deserves a deeper and more focused discussion. So, in this video, we take a closer look at what IFRS 17 is, why it was introduced, and why its adoption is so important for insurers, regulators, and the wider insurance market. We will break it down in a clear and practical way. So whether you are an insurance professional, a broker, a student, or simply interested in how the industry works, you will walk away with a better understanding of IFRS 17 and its impact. Let's get started. First question: what is IFRS 17? IFRS 17, which stands for International Financial Reporting Standard 17, is a global accounting rule that governs how insurance contracts are accounted for and reported. In simple terms, IFRS 17 tells insurers how to measure, present, and disclose insurance business in their financial statements. IFRS 17 is the global accounting standard that changes how insurance companies measure and report their insurance contracts, making profits, risks, and performance clearer and more comparable. It was issued by the International Accounting Standards Board, the IASB, back in May 2017, and it officially replaced the older standard known as IFRS 4. However, it only became effective for financial reporting periods beginning on or after January 1, 2023. So this is not a future change. It is currently live. Question 2. What is the origin of IFRS 17? The origin of IFRS 17 goes back to long-standing concerns about how insurance contracts were being reported around the world. For many years, insurance accounting was governed by IFRS 4, which was introduced in 2004 as an interim standard. IFRS 4 allowed insurers to continue using local accounting practices as long as they met some minimum disclosure requirements. While this approach kept the industry running, it created a major problem. Insurance companies in different countries, and sometimes even within the same country, were reporting their results using very different accounting methods, despite selling similar products and facing similar risks. This lack of consistency became especially problematic after the global financial crisis of 2008, which exposed weaknesses in financial reporting and risk transparency across the financial sector, including insurance. In response, the International Accounting Standards Board, IASB, began a comprehensive, long-term project to create a single, high-quality global accounting standard for insurance contracts. The goal was to improve transparency, enhance comparability, and ensure that insurance profits and risks were reported in a more realistic and forward-looking way. After years of research, consultation with insurers, regulators, actuaries, auditors, and investors worldwide, the IASB issued IFRS 17 in May 2017. The standard replaced IFRS 4 and introduced a completely new accounting framework for insurance contracts. Because of its complexity and the scale of change required, insurers were given a long implementation period. IFRS 17 finally became effective for reporting periods beginning on or after January 1st, 2023. IFRS 17 was born out of the need to move insurance accounting from fragmented local practices to a single, global, transparent, and comparable standard, strengthening confidence in the insurance industry worldwide. Question 3. What is the purpose of IFRS 17? The purpose of IFRS 17 is to make sure that all insurance companies across all countries speak the same financial language. It ensures that insurance results are reported in a way that is consistent, transparent, and comparable. Before IFRS 17, insurers were allowed to use very different accounting methods, even when they were selling almost identical insurance products. Two companies could insure the same risks, collect similar premiums, and face similar claims. Yet one could appear very profitable, while the other looked weak. This made it extremely difficult to truly understand how profitable an insurer really was, how much risk it was actually carrying, and how strong or fragile its balance sheet might be. Investors struggled to compare companies. Regulators found it harder to spot problems early. And even boards of directors could be misled by numbers that looked good on paper, but hid real risks. IFRS 17 fixes this problem. It introduces a single, global approach to measuring insurance contracts, one that looks forward, reflects real risks, and ties profits to actual service delivery. In short, IFRS 17 doesn't change insurance risk itself, but it reveals it more clearly. Question 4. What accounting procedures did IFRS 17 change? IFRS 17 did not just change how insurers report numbers. It fundamentally changed how insurance accounting is done. Let's look at the key accounting procedures that were directly impacted. First, the measurement of insurance liabilities. Before IFRS 17, under IFRS 4, many insurers relied heavily on historical assumptions. Discounting was inconsistent, and risk margins were not clearly defined. Under IFRS 17, this changed completely. Insurers must now estimate future premium inflows, estimate future claims and expenses, discount those cash flows to present value, and include an explicit risk adjustment for uncertainty. This means insurance liabilities are now forward-looking and regularly updated, not static figures based on the past. Second, the timing of profit recognition. Previously, some insurers recognized profits early, sometimes as soon as a policy was sold. Under IFRS 17, profits can no longer be recognized upfront. Expected profits are deferred and released over time as insurance services are actually provided. This directly affects revenue recognition procedures and how profits flow into the income statement. Third, the introduction of the contractual service margin, or CSM. The CSM is a brand new accounting concept introduced by IFRS 17. This did not exist under IFRS 4. It represents the unearned profit of insurance contracts. At inception, expected profit is recorded as a liability, not income. That profit is then released gradually over the coverage period. This changed how insurers track profitability, manage assumptions, and explain earnings movements. Fourth, how insurance contracts are grouped. Before IFRS 17, insurers could group contracts broadly, allowing profitable business to offset loss-making business. IFRS 17 introduced strict grouping rules. Contracts must now be grouped by similar risks, by annual issue periods, and by profitability. Loss-making contracts, known as onerous contracts, must be identified early. This directly changed portfolio segmentation and loss recognition procedures. Fifth, onerous contract testing. Under IFRS 4, losses could emerge gradually over time. Under IFRS 17, if a group of contracts is expected to make a loss, that loss must be recognized immediately. There is no deferral and no smoothing. This strengthened early warning mechanisms and forced insurers to address unprofitable business sooner. Sixth, presentation of results in the income statement and the separation of insurance versus finance results before. IFRS 17 requires a clear separation between insurance service results and insurance finance income or expenses. Underwriting performance and claims experience are no longer mixed with investment volatility. This changed how insurers present performance and how stakeholders interpret results. Seventh, discount rates and financial assumptions. Under IFRS 17, discount rates must reflect current market conditions, currency characteristics, and the timing of cash flows. Changes in assumptions must be tracked, explained, and reported transparently. This impacted interest accretion procedures and assumption update workflows. Eighth, reinsurance accounting. Reinsurance contracts are now accounted for separately from direct insurance business. The recognition of reinsurance recoveries, reinsurance CSM, and timing differences became more complex. This significantly changed reinsurance accounting procedures. Ninth, data, systems, and internal controls. IFRS 17 requires much more granular data, stronger reconciliation between actuarial and finance teams, robust systems, and clear audit trails. This transformed the entire financial close process. And number 10, disclosures and reporting. Insurers must now provide detailed disclosures showing movement in liabilities, movement in CSM, sources of profit, and sensitivity to key assumptions. This changed how financial statements are prepared, reviewed, and explained. In summary, IFRS 17 changed how insurers calculate liabilities. When profits are recognized, how losses are identified, how results are presented, and how data flows through the organization. It moved insurance accounting from being historical and flexible to forward-looking, disciplined, and transparent. And that is why IFRS 17 is not just an accounting update. It is a complete transformation of insurance accounting. Question 5. What is the impact of IFRS 17 to the Kenya market? To understand its impact locally, we must first understand where Kenya was coming from. 1. Why IFRS 17 matters in Kenya. Just like the rest of the world, Kenyan insurers reported under IFRS 4, which recognized profit differently across companies, allowed early recognition of long-term insurance profits, and made financial statements difficult to compare. 2 Kenyan insurers could sell similar motor or medical policies, yet show very different profitability, not because of performance, but because of accounting methods. This created challenges for investors, reinsurers, regulators, and policyholders trying to assess insurer strength. IFRS 17 was introduced to bring discipline, transparency, and comparability to the Kenyan insurance sector. 2. IFRS 17 and the Kenyan regulatory environment. In Kenya, IFRS 17 operates alongside the Insurance Act, Cap 487, regulations issued by the Insurance Regulatory Authority, IRA, and the Risk-Based Capital, RBC, framework. While IFRS 17 is an accounting standard, not a solvency rule, it strongly influences how insurers assess liabilities, price products, and manage capital. The IRA now reviews financial statements that are more detailed, more forward-looking, and more transparent than ever before. This strengthens market discipline and reduces the risk of hidden financial weaknesses. 3. Current value measurement, a big shift for Kenyan insurers. Under IFRS 17, Kenyan insurers must measure insurance contracts using current estimates of future cash flows. This includes expected claims costs, future expenses, policyholder behavior, and economic assumptions like discount rates. This is a major change, especially for medical insurers, motor insurers, and long-term life insurers. Previously, assumptions could remain unchanged for years. Now, assumptions must be reviewed regularly and financial results must reflect current realities. For example, rising medical costs, increased motor repair inflation, climate-related claims like floods and droughts are now reflected more accurately in reported results. 4. Contractual Service Margin (CSM), ending early profit recognition. One of the most important IFRS 17 concepts for Kenya is the Contractual Service Margin, or CSM. In simple terms, the CSM represents profit that has not yet been earned. Under IFRS 17, profits cannot be recognized on day one. They are released gradually as insurance service is provided. This is especially relevant for life insurance, education policies, pension-linked insurance products, and long-term medical contracts. This change discourages aggressive pricing to grow market share, unsustainable commission structures, and short-term profit reporting. Instead, it promotes long-term stability. 5. Impact on general insurance in Kenya. For most Kenyan general insurers, short-term products such as motor, medical, fire, and travel insurance qualify for the Premium Allocation Approach, or PA. This approach is simpler, but it still requires better data quality, clearer expense allocation, and stricter recognition of losses. Loss-making portfolios, especially in private medical insurance, commercial motor, and public service vehicle insurance, can no longer be hidden. If a group of contracts is expected to be loss-making, that loss must be recognized immediately. This has already led many Kenyan insurers to reprice products, tighten underwriting, reduce risk exposure, and renegotiate reinsurance arrangements. 6. Impact on life insurance and long-term business. Life insurers in Kenya feel IFRS 17 more deeply. Products such as whole life, endowment policies, education plans, and investment-linked policies require complex actuarial modeling. IFRS 17 forces life insurers to separate insurance service results from investment performance, explain profit drivers more clearly, and align product design with long-term value. This improves trust among policyholders, institutional investors, and pension trustees. 7. Systems, data, and skills, a major challenge in Kenya. One of the biggest impacts of IFRS 17 in Kenya is operational. Insurers have had to invest heavily in actuarial systems, finance transformation, data warehouses, and reporting tools. There is also growing demand for actuaries, IFRS 17 accountants, data analysts, and IT specialists. This has accelerated digitization, automation, and insurtech partnerships in Kenya. 8. What IFRS 17 means for brokers and intermediaries. For brokers and agents in Kenya, IFRS 17 indirectly affects commission structures, product sustainability, and insurer appetite for risk. Insurers are now more cautious about underpriced business, high-loss portfolios, and volume-driven sales. This pushes intermediaries toward better client risk assessment, advisory-driven selling, and long-term client relationships. 9. What policyholders should know. For the Kenyan public, IFRS 17 means stronger insurers, better risk pricing, and fewer sudden insurer failures. Some premiums may increase, especially in high-risk segments. But the trade-off is better claims-paying ability, improved transparency, and a more resilient insurance market. 10. The bigger picture for Kenya's insurance industry. IFRS 17 aligns Kenya with global insurance markets, international investors, and multinational reinsurers. It improves confidence in Kenyan insurers and supports the long-term growth of the sector. In summary, IFRS 17 is not just an accounting change for Kenya. It is a market-shaping reform. It rewards discipline, penalizes poor risk management, and builds trust across the insurance value chain. And ultimately, it strengthens insurance as a pillar of Kenya's financial system. And that brings us to the end of this long-form, in-depth discussion on IFRS 17. This standard is redefining transparency, profitability, and accountability in the insurance industry, and understanding it is no longer optional. It is essential. If you found this breakdown helpful, please like the video, share it with your colleagues and networks, and subscribe to the channel for more clear, practical insurance insights, right here on Insurance World TV. Until next time, stay informed and stay insured.